Hi, I'm Ross Mayfield, an investment strategy analyst here at Baird, and we are back with another Strategas weekly video. I'm thrilled this week to be joined by Ryan Grabinski, an investment strategist at Strategas. We're going to hit on a lot of things here, but Ryan, thanks for joining us.
Yeah, absolutely. Glad to be here today.
Yeah, great. So let's do a grab bag of stuff. We've hit on inflation in a lot of different ways, but I think the reason is because it is one of the more important risks out there right now. How do you guys see it? There's been a couple hot prints. We had some Fed activity. Where are you guys on inflation right now?
Yeah, very topical. Something we're focused on. We're of the view that it's going to be stickier than most people believe. We don't want to say that it's going to be like the 1970s inflation where it's really moving through the roof, but certainly we expect it to be higher than what it's averaged over the last 10 years. From 2010 to 2019, it's averaged about 1.8%. In our survey of institutional investors that we did last week, or we conducted last week, the average was about 2.9% annualized inflation over the next 5 years. If you look at break-even rates and what the market's sort of telling you about inflation rates, they expect it 30 years out from now, they expect it to be about 30 basis points higher than what it was prior to the pandemic. So, overall, we're of the view that it's going to be a little higher, a little stickier than most people anticipate. I think the real kind of takeaway from it, though, is that, this has an impact on multiples for the market. As inflation rates rise, you tend to see multiples compress overall. So I think, that's something you kind of have to keep in mind overall. In this environment, though, we do think it's kind of worth looking at those companies and securities that are really returning money to shareholders sooner rather than later. That's thinking about the companies that are buying back stock, paying dividends, rather than those that are, have their values tied to their terminal values. They're looking for, significant growth over the next 4, 5, 6 years out. So that's kind of how we're thinking about inflation.
Okay, that makes a ton of sense. So stickier, but not super problematic. And you mentioned it has an impact on multiples. It also has an impact on margins. You all have noted that before. If you have a lot of costs on your income statement that are rising, you're going to try to pass those on to consumers, but that can be challenging, even if you're growing sales really well. So are you all still optimistic about the outlook for equities? You mentioned kind of the types of companies you were focused on, the types of sectors. In this kind of inflationary environment or a little bit stickier, where do you all land on the rest of the year for the stock market?
Yeah, overall, we're pretty optimistic. The earnings landscape remains strong. Earnings for this year are expected to be a little north of 190, which is a significant improvement from what it was prior, to the pandemic even. So we're well ahead of those pre-pandemic levels. As you mentioned, margins are something we watch relatively closely. Next 12-month margins continue to move higher. They're now estimated to be about 16.6%. That's higher than what they were expected to be in 2018. So, we continue to see margin improvement. But, as you bring up the idea of cost, it certainly is something that we have to be concerned with, right? Labor shortages are certainly leading to higher companies having to pay higher wages. That is a cost that they'll ultimately incur. The fiscal stimulus is something else that's going to be wearing off. To the extent that it wears off, this could certainly impact consumer spending. So that is something we are a little concerned about, but overall, we don't think it'll be detrimental. At the end of the day, we still have 7.5 million individuals less employed than what we had prior to the pandemic. So, there is going to be some sort of support. The government is going to be mindful of that. And ultimately, it's hard once you start offering this fiscal stimulus, it's hard to really wean yourself off of it. I think the kind of the big takeaway is ultimately, markets don't necessarily move up in straight lines. We've kind of become accustomed to that over the last 15 months. We only had one correction of just under 10%. But we have to come back to the idea that if we have a strong 10% year, that's a solid year for the markets. These 18 to 20% years are not normal. That's not the ordinary. If we're up 8 to 10%, that's another good year.
Yeah. I think we all need to check our expectations a little bit after this last run. We talk about inflation, and one thing you'd expect to see if the market were anticipating higher inflation is higher yields. The 10-year yield has been kind of stubbornly low. And you all have actually talked some about how in the past, the 10-year might have been the one indicator that someone would want if they were going to look at the markets and tell you, what the economy was doing, what to invest in. You all have kind of changed your tune on maybe it's not the 10-year anymore. Maybe it's the US dollar. Could you talk to me about that briefly?
Yeah. We've definitely think the dollar is probably that one sort of metric to watch these days. Currency markets are deeper than the treasury markets, especially when they're not being manipulated by the Fed. Obviously the Fed is continuing to purchase treasuries, so they can't impact the currency market the same way that they're able to impact the treasury market. Our overall view is that the dollar should continue to weaken, and it should continue to give life to the reflation trade, as it's typically when the dollar weakens, commodity prices rise, and that bodes well for the energy and material stocks. I think the reason we're watching it because lately we've sort of seen a pause in the dollar. We've even seen it turn a little higher, and that's kind of given some life into some of the growth sectors. But if you think about what the fiscal deficits are and where they're projected to be, the dollar in the longer term should continue to weaken, and that's kind of our view, and that's why we're sticking to this sort of reflation idea. We like the materials, we like the energy sector, we still like financials overall. So.
That's great insight. So we've got stickier but not problematic inflation. We've got a potentially weaker dollar. We've got some sectors that we like and strong returns, but let's temper our expectations a bit. I think that's a really good level setting to head into the second half of 2021. So I want to thank you a ton for your time today.
Yeah, thanks for having me. Always a pleasure to be here.
Yeah, anytime. Thanks.